The battle for the control of money, China and the gold market. Major Chinese banks, including ICBC, have announced the shutdown of paper gold trading, margin trading, and futures for retail investors by July 24th. However, people can still buy physical gold. The official and unofficial stories. Official reason: protecting citizens from market volatility. Due to sharp price swings, banks have raised margin requirements to a record 140%. Real reason: theory. The battle for true price discovery. China wants to eliminate speculation via paper contracts, which have artificially suppressed the real value of gold for decades. The paper gold problem. The Western gold market, London and the COMEX in New York, largely operates like a casino. A massive amount of paper contracts, claims on the asset, are issued, vastly outnumbering the actual physical bars in the vaults. If all paper holders demanded their physical gold at the same time, the system would collapse. China aims to reveal the true price of gold by removing the influence of these paper speculations. What are central banks doing? The smartest players in the market, global central banks, are shifting their decades-old strategy: record purchases of physical gold. In the first quarter of the year, central banks bought a net 244 tons of gold. Moreover, a huge portion of these purchases, especially by China, remains in the shadows and goes unreported. Mass sell-off of U.S. national debt. For decades, countries parked their excess cash in U.S. Treasury bonds. Now, foreign central banks, including China, are dumping U.S. debt and rotating their capital into gold. This is a clear signal of declining trust in America's fiat currency and its financial system. China's plan: a new settlement system. China is building an alternative financial infrastructure that is outside Western control, the Shanghai-Hong Kong connection. The Shanghai Gold Exchange will provide pricing based on actual physical delivery, while Hong Kong will act as the international trading hub. To support this, Hong Kong is already expanding its physical vault capacity from 200 to over 2,000 tons, a gold anchor for the yuan. If major commodity deals can be priced in yuan and settled against real gold in vaults, it will give the world a reason to trust the Chinese currency. This is a direct challenge to the dollar's hegemony without going to war with the US. The potential U.S. response. How can the U.S. defend its currency monopoly? Revaluing gold reserves. The U.S. government allegedly holds around 8,000 tons of gold. However, due to an accounting rule from 1973, it is officially valued at just $42 per ounce. If revalued at current market prices, around $4,000, roughly $1 trillion in value would instantly appear on the Treasury's balance sheet. Gold-backed bonds. There are proposals floating around in the U.S. to issue 50-year Treasury bonds that can be redeemed in either dollars or physical gold. This would be a mirror response to China, an attempt to partially back the dollar with gold again and reinforce global trust in the American system.